Hi Shane, how are you?
Good, Olga, and yourself?
Good, thank you. Thanks so much for joining me again today. The last video we did, I think, was got a lot of views, and a lot of people are very keen to hear what we've got to say on how we can help people in a number of different ways. So thank you for coming again.
No, thanks for having me again. It's always good to chat.
You come in the insolvency and restructure space, where a company may not be, or an individual may not be viable anymore, and not able to pay the debt, or there is a better solution around the restructure. And we come in where people have a tax debt and need assistance with a payment plan, but don't want to go down that insolvency route, so to speak. One of the things that we're seeing a lot, and is a lot in the marketplace, and I think there's even some people potentially buying lists around this, is a number of our clients are being contacted around small business restructures, and people spruiking, so to speak, the option of a small business restructure, or as we call it, an SBR. So I thought it would be really good today to do a bit of a deep dive into SBRs. Your view, there's obviously, with everything, there's pros, there's cons, and one of the reasons that I personally love working with you is that we look at what the right solution for clients is. So we can sort of go through some examples as well where they're better on a payment plan, or they're better with an SBR. So
Yeah, for
did
sure.
you did you want to sort of explain in layman's terms, all the way back to the beginning, what a small business restructure is, and the purpose of it?
Yeah, sure. Well, the small business restructure was one of the initiatives of Josh Frydenberg during the COVID pandemic, which was an alternate solution to companies that were facing financial difficulty. And obviously, they expected, there was a lot of terminology around the time saying that there was going to be a tsunami and all of
Yeah.
that sort of stuff. But people forgot that also that the government was obviously quite lenient and generous with its handouts at the time, which meant that businesses stayed afloat, and there wasn't a lot of insolvencies. But the SBR, or the small business restructuring process, was introduced as part of those reforms in 2020. Since then, it's been on a sort of, it was a slow start, but in recent times it's been on a bit of a meteoric rise because, one, people are understanding it more. Two, there's a lot of collection activity out there, especially driven from the ATO, but also by other creditors, which is making directors have to consider their solvency position. But the long and the short of a small business restructuring, it's a different type of model. Most insolvency processes, or processes that do with companies in financial distress, they hand over control to a registered liquidator, with someone like myself. But in a small business restructure, the directors stay in control of their business. There is some requirements to get into a small business restructure. Those requirements are, you've got to be up to date with your tax lodgements, you've got to be up to date with your employee entitlements, including superannuation, and you shouldn't have done it before in the last, or you can't have done it before in the last 7 years. So once you've done one, you're knocked out for the next 7 years, and that's for the individual, that's the director as well as the company. So it's something that needs to be thought about and doesn't go in too lightly. But I think the fact that the directors get to stay in control, it's a short process, or relatively short. It's 35 business days is the usual time frame, and businesses can come out with a reduced amount payable to its creditors should the creditors resolve to accept the plan that's been proposed.
One of the things that we're seeing a lot of is directors that have received a director penalty notice, but that it's actually expired. So when the director penalty notice is expired, that director is personally liable for that debt. An SBR won't get rid of that expired personal liability. Is that correct?
That's correct. Yeah, like once it's expired, once you're into that lockdown phase, the only way to deal with it is in your personal capacity. So it's either going to require some payment, and usually, that's where, in circumstances where sort of tax control comes in, and you can organise that payment plan over time for the individual to deal with that personal liability that's attached. But it's still worthwhile in some instances, not always, but sometimes it's still worthwhile looking at the business, because whilst it might not fix that lockdown director penalty notice, the business may still need that breathing space. And the fact that the liability is a parallel liability, you might get a discount in the company. You'll still have the personal amount, but the company will be able to pay a portion of that under its payment plan, which will reduce the parallel liability to the individual, and the individual can still be in a payment plan organised, through yourselves to deal with their debt over time, which just makes it gives them some breathing space, which means that the company survives, the business survives, and their means of income survives. But it's a case by case scenario, like with every single administration.
We had an example of where an SBR wasn't the right solution recently. A client came to us and their super debt was $200,000. They had expired DPNs, and the difference between the company's liability and the director's personal liability was $30,000, and there was $80,000 of interest on the account. So they had received some advice that they should borrow against their house to pay out the $200,000 super, pay a different insolvency practitioner $20,000 for an SBR. They were only going to be looking at a portion of $30,000 in which they could potentially save. And what we were able to do in that case is put it all into a payment plan and actually look at an application to get rid of the interest and penalties, which meant they would have reduced the debt by $80,000, and they weren't taking out, they were actually going to both take money out of their house and money out of their own personal super to pay the company super. So I think the moral of the story, as it always is, that there is no one cookie cutter approach, and that's got to be the right advice for the right circumstances. There's other situations too, which I think people get a bit confused about, that an SBR is still in some instances considered as an event of insolvency. So for licensing and insurances, did you want to tell us a bit about that as well?
Yeah, for sure. Yeah, look, at the mere appointment of a small business restructuring practitioner and initiating that process is an act of insolvency in itself. And, other creditors, whilst there's the small business restructuring is going forward, there's a moratorium. So similar to a voluntary administration, there's that moratorium where creditors can't actually take action to pursue guarantees and their debts and things like that. But if it gets out the other side of a small business restructure and the plan either hasn't been accepted or the decision period lapsed and there was no plan put, so the small business restructuring process is terminated, all of a sudden you've got an active insolvency for which creditors can then immediately proceed to winding up proceedings. They don't need to go through the creditor statutory demand process to create that active insolvency, because it's already been created for them. In terms of licensing, it's quite interesting how different jurisdictions are dealing with licensing. The building industry, for instance, usually it's the insurance that becomes a problem, which means that you potentially could lose your license, especially in Victoria, because you can't get insurance. Now, so far, we've seen, the experience we've had is that the builders have been able to retain insurance despite there being an external administration, and therefore been able to retain their licenses through an SBR. There's actually specific provisions for it in the QBCC in Queensland. So that also means that SBR is quite a good option around the smaller builders who want to try and retain their license. It's always a bit of a moving feast because we don't control the insurers, we don't control the VBA, but that's our experience to date, is that's what's been happening in Victoria. And like I said, QBCC has its own rules, and they're sort of different all around the country. But for the most part, SBRs are going really well. And then in terms of other licensing, so we've had one with some liquor licensing, and that's been still okay. So it's definitely something to be mindful of, and sometimes that's why you choose an SBR potentially over a voluntary administration, especially around construction.
Are there examples where it wouldn't be right? Like the example that I used, it just wasn't a commercially viable solution. It was going to cost a lot more to really not achieve a lot. Are there situations in which you've seen that have come to you? I know that director loans is a big issue as well, where an SBR wouldn't be the right solution.
Yeah, no, for sure. And look, director loans is a good one to raise, because we do see a lot of Division 7A director loans sitting on balance sheets. And if the ATO is your major creditor, the ATO have their own set of rules or their own set of guidelines that they
Yes,
want
I
us
know
to play
about those.
by.
Yep.
Yeah. So even though it's not enshrined in legislation and it sits outside of the legislation, obviously if they're the creditor voting for it, they sort of get to dictate somewhat as to how it proceeds. And they don't like to see debit loan accounts. They want to see those repaid. And obviously if their capacity is to repay them, then you've got to balance that out against what would an SBR outcome be versus the repayment of this loan. So direct debit loan accounts are quite problematic, especially where the ATO is controlling the day in an SBR vote. We've had other instances where it's just the business isn't trading. There's no viable business behind it. And it just doesn't make sense to put forward a small business restructure where you're not having effectively an ongoing outcome out the other side. In those situations, you get there and say, well, it just makes sense to be in liquidation and allow the liquidators to do, proper investigations around, any antecedent transactions such as voidable transactions and things like that. But that's one of the reasons why directors might want to choose an SBR. But in those instances, it'd be pretty, again, if the ATO is voting, they do want to see business cases and they do want to see that there's a live viable business, and a lot of their questions and a lot of their guidelines are set around that.
Yep. And in cases of the director loans, that's often where we come in. Sometimes there's been bad advice, sometimes there's been late lodgement, sometimes there's been a huge debt that's built up. I had one just this week where someone said that they were advised to not take a wage. They were a director and there was 5 years of director loans that hadn't have been reconciled. So in those instances where we're able to come in and get them a payment plan, whilst all of that is happening, they're protected from further action as well. So no recovery action will happen whilst we've got them in a payment plan. So again, I think it's sort of horses for courses. It's making sure that people get the right advice around what the right solution is, and there is no magic pill fix. There's no quick fix. I think during COVID we were looking for quick fixes, and some of the measures implemented by the government were meant for that. But as things have moved on, it's slightly different to how it was back then.
Yeah, for sure. Yeah, no, it's definitely moved on. But look, we've all got better at, with the guidance of the ATO, obviously sending out their guidelines and us as practitioners doing more and more of these. They're very popular now. They're second only to liquidations in terms of type of appointments, which is a good thing because these are cases that probably would have possibly been liquidations had there not been this process. So it's just, the process is getting better, it's getting more refined, and I think it'll only get better as, a few of the nuances that are still in there from a practitioner point of view, the clients don't need to worry about this. Once they're ironed out, it's going to be a very welcome process. It just be nice to have that $1 million debt threshold lifted.
Yeah, so that's the other thing we haven't actually specifically mentioned, that if the debt is more than $1 million, then a business won't qualify for a small business restructure. So that's another
correct.
spot that we jump in. And also the super. So often we see that the super debt is very large. I know that there's a number of companies out there talking and spruiking around different ways to pay off the super so that you fit within the SBR regime. But a lot of the time there is not equity left in a director's house, or to borrow at such high interest rates just doesn't make commercial sense to pay off that super. Whereas when they are a viable business, there is money coming in and we're able to get them a long-term payment plan, that's a real alternative to solution often to an event of insolvency.
Yeah, absolutely. Yeah, look, if it's all like that case you mentioned before, where there's only 30 grand of potential benefit as an SBR, like the commercial benefit and the commercial case for it's just not there. You'd want to be achieving some level of significant cost savings, which is going to then provide a positive impact and a positive cash flow position to your business. And, a 30 grand difference in the entirety of the thing where you're spending 20 just doesn't make sense, and it's not going to move the needle at all. So yeah, in those sort of situations, payment plans, reducing the debit loan account and cleaning up the balance, cleaning it up over time through personal negotiation and, using yourselves, just makes much more commercial sense than wasting your money on a practitioner to achieve very little result, and especially when it's going to exclude you from using the process for the next 7 years. So what you'd be better off doing in those sort of situations is keeping your powder dry, getting a negotiated payment plan through Tax Assure, running it, and if at some stage in the future the business then suffers another event which causes a cash flow position, you still have the ability to do a small business restructuring at that time, but you're still already in a compliant payment plan with the ATO, which can continue once the small business restructure is in place. And by then, if you've been compliant that whole way through, the benefit achieved from doing a small business restructure will be there.
And again, I think that's we're looking at strategic advice. It's not a quick fix. It's not a magic pill. It's what's the right solution around that real strategic space. While we're talking about new initiatives, I don't think it's an initiative. I think it's a new law. Something that is hot at the moment is the changes in relation to GIC, which is general interest charges. So I think that's going to change the landscape a bit as well. So as of 1 July this year, any new tax debt, new ATO debt, the interest incurred on that debt will no longer be tax deductible. So you can still do an application under the law for a remission to get that interest remitted back if there is a case for it and factors for it, which we do a lot of work around. But prior to this, any interest that's been incurred owing to the ATO, you've been able to include in your tax as a tax deduction. Do you think that's going to change a lot of business owners' views on using, I hate to say it, using the ATO as a small business bank, which the ATO want everyone to stop doing, which they don't like us doing, which I think is a huge factor behind this law coming into place. But do you think there'll be a bit of a shift in thoughts around this?
I think the ATO and government would like to think that there's going to be a shift. I personally think that most of the directors don't give it a second thought. They're too busy worrying about controlling their business and other parts of their business, and tax is the least of their concerns until such time as it's at the forefront of their mind as a result of an orange notice or a red notice coming through to them on a director penalty or stat demand, and then it becomes at the forefront of their mind. What it's going to do, though, is it's going to potentially change the advice that they receive from their accountants, about their dealing with tax debt, maybe also around loan accounts and things like that. So there might be a shift in advice from the advisors, but I don't think we're going to see necessarily a shift in behaviours unless they've been through it before.
Yeah, I think it's also interesting where you bring up the orange notices and the red notices. So internally, we and the people within the industry call them orange and red notices. The oranges are warnings, what we call firm action warnings, and the reds are almost like a letter of demand, pay now. One of the interesting things that we're noticing is we're not actually seeing very many orange notices. We're seeing the ATO go straight to recovery action. So we're seeing director penalty notices being issued without an orange notice, and other recovery action happening in that space as well. When we talk about director penalty notices, I think it's super important even to touch on those again around acting and getting that advice straight away. What are some of the tips that you would give people both before they've got a director penalty notice around lodgements, the impact of these late lodgements, and then how that can change a director penalty notice for people?
I guess first tip is make sure that if you do have a tax debt and you already have a tax debt, then make sure that your address as a director is updated both on the ASIC record and with the ATO, because you do not want to miss one of those notices because it gets sent to an old address. We've had plenty of people come to us saying, I never got the notice, and obviously the legal advice that they go and get afterwards was, well, that doesn't matter. The notice has been issued, you failed to comply.
Yep,
it's dropped dead. You
Yep.
can't rectify it. Now, if there's a defect in the notice, that's a different story, and that's a whole you know,
That's a whole nother day.
another
We
mind.
need we need
That's a whole
Nigel on
nother
here.
minefield. Exactly,
If
exactly,
there's a defect, Nigel needs to come onto this
exactly.
YouTube as well.
No, exactly right. So, but yeah, so that's the first tip, because we have seen quite a few, and especially recently, where that's occurred, and to get away from, I guess, the Australian taxation office, it's also important from the state revenue
Yeah, SRO,
office's position
absolutely.
as
Yep.
well.
Yep.
And we're seeing the SRO being a lot more active, especially around, uh, you know, land tax,
Land
vacant
tax. Yep,
residential land
absolutely.
tax is now
Yep.
coming in as well. So it's important to have those addresses up to date. So that's the first tip. The second tip is to make sure that you, even if you can't pay, lodge. Um, and I'm sure from your point of view as well, Olga, like I know that the ATO views an SBR or a voluntary administration deed proposal, deed of company arrangement proposal. They view those much more favourably if you've been a compliant taxpayer by the mere fact of lodging, even if you haven't been able to pay. The ATO wants to know what the debt is, so lodge. And the great thing about lodging is that gives you the 21-day time frame. If a director penalty notice does get issued, you then have 21 days to decide whether or not you're going to be able to pay, and whether you're going to be able to, if you can't pay, then are you going to do one of the other options on that notice, which is to appoint a voluntary administrator, a small business restructuring practitioner, a liquidator, or go into a simplified liquidation process. So it gives you options.
Yep. And with the lodgement piece, when we're looking at getting people payment plans, one of the big things, as you mentioned, the ATO are looking at is that past compliance. And they're very big on compliance history. And in the past, we've heard people being given advice: if you don't lodge, the ATO won't know about the debt. They know about it. They know that there's late lodgements. They know that there is a debt, and that history of that late lodgements affects your compliance, both for payment plans and any negotiations moving forward with the ATO. One of the other things with a DPN that we find people get a little bit confused about is that you're exactly right with the 21-day period in what needs to happen, but you can still negotiate a payment arrangement for the company, and we can still negotiate a payment arrangement for an individual, even if there is a DPN on foot.
Yeah, yeah, absolutely. It's just a matter of, the personal liability position that attaches
Yes.
to obviously the non-compliance with that notice under the legislation. But there's plenty of instances where we've seen that it's better that they go to you, get into that payment arrangement, even though that there is some personal liability attaching.
Yep.
And it's just making a concerted and informed decision as to whether you're going to take that on or not. And we've had plenty do it. So.
Yep. And that you mentioned too before, they're parallel debts, which I think a lot of people don't understand. So I often think of it like two columns. So if an individual gets a DPN, that's a parallel in the same debt that the company has. So if the company is in a payment arrangement and starts chipping away at that debt, the ATO won't enforce the DPN against the individual.
Yeah, absolutely. So, and that's the primary driver is, you want to keep the business alive so that it can continue. So, the very first assessment's got to be, is this business viable? But for the current cost of the debt, or despite the cost of the debt, it's still viable. It's just suffering some short-term cash flow issues, which can be remedied by other ways, like if there's a debit loan account there, it might be the director, pays back the debit loan account, or they might recapitalise it. There is other ways to deal with it. And ultimately it comes down to the directors being, having spoken to yourself, Olga, or having spoken to us or both, or spoken to their lawyer or accountant, that they're getting the best, most informed advice that they can, and then making an informed decision based on that advice, and then going into it with, their eyes wide open to know that, hey, yes, I'm going to go down this path, but that path means personal liability, but I'm confident that my business is going to be able to pay back this debt over time, and therefore it's not going to be an exposure to me. Or, hey, we're in such a catastrophic position that I actually do need Shane to be involved. And then obviously in between that is payment plans and dealing with that over time, smooth out those cash flows. So it's a comes back to what we said at the very start, which is it's not a one size fits all. It's specific circumstances, not only around the individual, but also the company, and at a deeper level, it's industry, what's expected in the future. Like it's a multifaceted approach.
Yep. And for those that have watched many of those videos, it's also about the frog. You've got to eat the frog. Yeah. We can't ignore this step.
Can't have got this far into a chat without talking about the frog.
I know. We're not talking about a frog. My frogs are everywhere. But it's a very real thing, and I understand how stressful this is for people. But if you are watching this, I keep talking about people watching this in the middle of the night because I have so many phone calls about people that watch these videos. They don't know what to do and they're really stressed. It is taking that first step, having a chat with you or me or whoever your trusted person is, to take that first step, because burying your head in the sand. People used to say to me, "Oh, when or if I hear from the ATO, then I'll deal with it." That if is no longer an if; it's just a matter of timing now. And the more you are proactive, the more you get on the front foot to work out with the right advice, the right specialist, the solution, the better the outcome is going to be.
Yeah, absolutely. Like early advice has always been the key, and you'd see any professional worth their salt in this space saying exactly that early advice is the key. Doesn't mean that you necessarily need to make an appointment, but at least you know where your exits are. So you've planned. You go. You're sitting at this point now. You know where you're wanting to try and get to. You know the hurdles that you've got in your way, and by doing that, you can then plan your exits to say, well, hang on, if this doesn't come off, then I've got to call Olga and get into a payment plan. Now, if the next thing doesn't come off, then okay, that's a call that I've got to call Shane. And just knowing those exits means that you then have a plan, and then you have some guidance, and you're just not hoping, because hope is not a strategy. It's just you've got to have a plan to deal with it, because it's not going to go away. Because the reason you're in here potentially is because there was circumstances beyond the control that you didn't plan for, and now we need to plan how we're going to deal with this. So it's early advice is always the key. And look, you've probably had the same thing, but the amount of people that come into my office think you can see the weight of the world on their shoulders.
Yeah. Absolutely. And it just it just lifts.
It lifts.
Or the tears. I can hear it in their voice, and they're like, "Why did I not speak to you earlier? Why did we not just pick up the phone?" And I love that term, the exits. It's the strategy of what we're going to do. And we are here to help. We're here to get the best outcome for the clients that we possibly can, to get them wherever that next step might be. Thank you so much for chatting with me today, Shane. I think the moral of the story has been get advice, eat the frog, and plan your exit. So thanks so much for chatting to me today.
Yeah, no, thanks for having me as always, Olga. It's always great to chat.